Hi friends, Jackie Dunlap here, your Rise sister. I want to take a minute to introduce myself in case you don't know me very well and explain to you how uniquely qualified I am to talk with you about mortgage loans. I started in the industry in 2005, right before the market crashed the last time. And I had about a 3.5-year hiatus. So after my hiatus, I got back into mortgage in 2012 and have been in mortgage ever since. I got my mortgage loan originator's license in 2014. I had a small processing company, and then in 2016, I decided to open my own brokerage, and that took me about 3.5 months. In January 2017, I opened my own brokerage, Next Generation Home Loans. I have 4 loan officers that work for our company. We have a full-time processor and 2 loan officer assistants. Topic number 1, forbearance. Well, here's what I can tell you about forbearance. Forbearance is not forgiveness. And forbearance on mortgage loans isn't the same forbearance that we experience with student loans. And what happens in student loans when you get a forbearance is those 3 payments or 6 payments, however long you're in forbearance, just get tacked on to what we call the back end of your loan or the principal balance. Mortgage forbearance is not the same. So what happens is if you, for example, are unable to make your April 1st mortgage payment, first and foremost, call your servicer. Your servicer is the company that collects your payments. It's who you make your payments to or whoever's website you log in to make your payments. You want to call that company and discuss with them how you've been affected or infected by COVID-19. That is the very first thing you need to do. Forbearance, let's say right now you're unable to make your April 1st payment. What they do is they set that payment aside. When May 1st comes along, you're still going to show due for April 1st, and now you're due for May 1st. Then the next month, when June 1st rolls around, you're still going to be due for April 1st, you're still going to be due for May 1st, and you're still going to be due for June 1st. It's only allowing a temporary set aside, not forgive it and put it on the back end, okay? Going to be due. Here's what we don't yet know. We don't yet know what the directive is going to be on reporting after the forbearance period. But the way that it works now and what we know right now is that come July 1st, if you do not make all 4 months payments in July 1st, you will be reported however many months you are late. If during that time you are unable to make April, May, June, and July, you're pretty much automatically in a pre-foreclosure status. Logically, it doesn't really make sense to me if you can't make April or May or June, that we're still going to have people be responsible for 4 months. This appears to model some of the forbearances when we have natural disasters. I think one of the differences is that when you're in a natural disaster, sometimes FEMA steps in and gives people money to rebuild their housing, help with housing. FEMA's not stepping in here, and nobody's making your payment. Next question. There were several questions regarding qualifying for a home loan right now, either being pre-approved or currently in the process. Is this going to affect me? More likely than not, yes. If you're selling a home right now, the first 2 things that I would really urge you to do is have your listing agent call the lender for your buyer. Your listing agent should have received a pre-qual letter from your buyer's lender and check in. And what we're seeing is lenders are tightening up, what we call tightening up or restricting or making the box smaller on what criteria a buyer or borrower has to have in order to qualify for a loan. One of the biggest things that we're seeing is new credit score requirements. So on Monday, I could do an FHA or VA loan down to a credit score of 500. Friday, I can't do loans under 620. Those are some of the fallout. Next question. I'm currently in the process of buying a home, but my closing date's a little bit further out. Either I have a closing date set out or I'm doing new construction and I'm not planning on closing until later in the year. I can't really give you advice specifically on what you should do because every borrower's credit profile is as unique as our DNA. Even though my husband and I have been married for 13 years and we share a lot of the same accounts, we had a 25-year life before we ever met. So even though our scores a lot of times are very similar, they're still uniquely different. So I can't really give you a blanket statement on what you should do for a rate lock. But what I want to do is give you information that can help you better decide when the right time to lock in a rate might be. Well, here's what we can tell you. The conversation on the backside is that everything that we normally would watch in the stock market in regards to how interest rates are basically done for mortgages indicates that we should be seeing much lower interest rates than we currently have. So why don't we have much lower interest rates? Well, I'll tell you. When COVID-19 started presenting its ugly face in the European side of the world, there began to be some fears about what this was going to do. When that happened, interest rates took a dip. This was about the first week of March. So a lot of people, and I mean a lot, jumped on board to get a refinance. Well, how many is a lot? To give you an idea, normally in any given year, we do about $2 to $3 trillion in mortgage loan lending. In the few weeks of March and the last week of about February, it's estimated that $11 trillion in loans were submitted for refinance or purchase. Well, now back to basic economics, we have a huge supply and demand issue. There's a lot of demand for loans, but only so many hours in a day and only so many people who can make that happen. And as in any situation of supply and demand, typically the price goes up or stays high instead of coming down. And that's why right now we have some artificially high rates. They're still very, very low rates, but they're artificially higher than what we would expect given the key measures that we watch on the stock market. So again, what does that mean for you in locking in interest rate? And when do we expect to see them rebound? The conversation in our industry for the last week is that we expect to see an economic rebound sometime in the third quarter. Because of the economic impact that's happening right now and what begins to create a recession for us is going to require that rates stay low for an indefinite amount of time. So once we kind of come out of this crisis, once we start to come out of the high unemployment, once our economies and our countries start coming back to work, we'll start to see the normal activities that happen in the market again. We are really trying to make sure that we stay staffed and are prepared for the influx of volume that we are anticipating for the fourth quarter. So you have to take that advice, talk with your loan officer, and discuss when the best time for you is. If you are my client, the conversation I'd be having with you is if you're closing in the fourth quarter, probably wouldn't advise that you lock right now. Also, locks get more expensive the longer that you lock it for. A 15-day lock has a better price than a 30-day lock. A 30-day lock has a better price than a 45-day lock. 60, 90, and about the maximum you're going to see right now is a 120-day lock. So if you're not closing in the next 4 months, chances are you're probably not going to be able to lock it anyway. Next question. Does unemployment affect my credit? In and of itself, no. Your source of income or the job you work or how you get paid isn't a factor that's taken into consideration while considering and making up your FICO score. I'm currently in the process of buying a home or qualifying for a home, and I'm self-employed. Is that going to affect my ability to qualify for a home loan? Chances are, yeah. Here are some of the things that we're seeing. What we are seeing is some banks are creating what's called an overlay, and that is their own specific rule on top of the rules provided by Freddie Mac and Fannie Mae. What we're seeing is some of them are reducing what your qualifying income is by a percentage, 10, 15, 25%. So that means if you normally would otherwise make or show $100,000 a year in income, they're going to reduce your qualifying income to 90, 85, or 75,000. And that would definitely impact what you qualify for. The other thing that we're seeing is a higher reserve requirement. A couple of things is if you own other homes like rentals, we're going to want to see that you have more reserves to cover, which is money left over after your current transaction, to cover the monthly mortgage payments for any rental properties you have. Again, because we know so many people are losing their jobs, the confidence that anybody who owns an investment property and the ability for their renters to pay that and that liability falling to the homeowner with no rent income in return, they're going to want to see that you have a few months tucked away to cover those payments. The other thing that we're also seeing is that for regular primary purchases, they want to see a couple months of reserves, which is money left over after you complete this transaction, in order to carry additional payments on your house in case something happens with your job that's unforeseen. So these are a couple of the things that we're seeing changing. I also want to talk to you really quick about government lending. This is going to be FHA, VA, and USDA loans. Well, I haven't really seen a written confirmation. Some of the things that we're talking about and the sources that they're coming from have so far told us these things about 48 to 72 hours before they come down the pipeline. So somebody's knocking at my door and my dog might go crazy. If she does, we'll come right back. What we are hearing is that there is talk about a complete restriction of funding government loans after April 15th. I don't have all the answers on what this means. What does this mean for you if you're doing an FHA, VA, or USDA loan? You need to call your lender and see if there's anything that you can do to close that loan on or before April 15th. Some of the things that we would probably try and do in our brokerage is pay for a rush appraisal. If you're a borrower or buyer, you need to make sure you get all your documents in the same day or next day that you're asked for them. The sooner you can get those in, the sooner they can get to an underwriter and the sooner they can be approved. Friends, I don't really have much more answers on that part. I expect that we'll see more come out, especially as we roll into April. But I've heard it more than once from very trusted sources, and I'm hearing things 48 to 72 hours before they hit the mainstream. So I'd be amiss if I didn't tell you that this is a real concern. And if you have this type of financing, you need to keep your eyes and ears glued to your loan officer or your lending institution. I would say probably once or twice a week if they're not calling you. The other thing that I would tell you is if you're using one of these loans, start having the conversation with your loan officer on what it would look like to switch to conventional financing if these loans don't go through and you want to continue moving forward with your home purchase. Friends, I know firsthand what this is doing. I know firsthand for all of you, not only because I work in this, but I had a home for sale in Denver, Colorado. 2 weeks ago, I signed as a seller on a Friday. Our buyer was supposed to sign on Monday as a buyer, and we got an email Sunday night at 8 o'clock that our buyer was backing out. Our property now is back on the market in the midst of all of this. So not only do I understand it because it's what I do for a living, but we're also walking these waters with you. So if you have any further questions, please comment below. I will be checking in periodically to answer those questions, and you can DM me if you have a more personal question. If you are a veteran or the spouse of a veteran, I want you to go and find Vetted VA. It is a group that we have started in our industry with giving guidance to veterans in the financial realm and a bunch of things that really revolve around that with people that have been vetted to be people that really honor and take care of our veterans. So if you are a veteran or you are the spouse of a veteran, please go look on Facebook for the group Vetted VA. In there, you can also use the search